Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Covered Calls and Short Puts. And today we're going to be talking about a concept known as the Goldilocks covered call stock. What might a trader see in a stock that might indicate to them that it might be just the right candidate for a covered call? I think this is going to be an interesting discussion. We're going to be looking at example stock and weighing the pros and cons of adding it to our example portfolio as a covered call candidate. Should be an interesting discussion, as I said. But before we can get to that, though, let me first of all say hello to everybody who's already chatting in. Great to see a lot of familiar names out there in YouTube. There may be one or two that are new to me, so hello to you. But hello there, Mark and Eva, Jesse, Tony, Jackson, Josh, Lawrence, everybody else. Thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. If you happen to be among those here who are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. It's a great way to watch these webcasts, but you're certainly invited to join us in this live discussion. This is a Monday webcast series. We kick things off promptly at 2 Eastern time. If you'd like to be here, we'd love to have you here. But I also want to let my live audience members know that my very good friend Ben Watson is hanging out in the chats. Ben's going to be keeping an eye on any questions that roll in that I can't get to just during the flow of the presentation. Ben's a fabulous coach and presenter himself. We've worked together now for over 2 decades. So Ben, brings a ton of experience to this. Thanks for having my back there, Ben. Ben and I would also like to issue an invitation to everybody watching, whether live or on the archive, to follow your favorite Schwab presenters on social media. You can find Ben and me on X. You can find Ben there at Ben Watson CS. You can also find me on X at Cameron May CS, or you can pop over to LinkedIn. Just go to linkedin.com/in/Cameron May CS. That'll take you to my profile. Give me a follow, and that's where to connect with me in between these live streams. But let's get into this discussion. Of course, as we do, we need to first of all consider the risks associated with trading and investing. Risk is real, so bear this important information in mind. Options carry a high level of risk and are not suitable for all investors. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's set the agenda for today's discussion. As we always do, the first thing that we're going to do is take a look at what's going on with the example positions that are already in our paper money portfolio. We'll just see what's happening with those, get a little update, see if anything needs to be changed. And then we'll take a quick peek at the markets. I won't spend much time on that, but I do think it's important to use market conditions as a backdrop for these sorts of discussions. But we're going to spend the bulk of our time discussing what I mentioned is this concept of the Goldilocks stock as a covered call candidate. What might make something, or what might a trader look for to see if their stock is just right for doing a covered call? Now, is anything perfect? Nope. But we're going to be talking about what a trader might be looking for as they're weighing adding a covered call to a portfolio. And we're then going to place a brand new trade in our example paper money portfolio. Should be, as I mentioned, great discussion. Let's get right to the Thinkorswim desktop and get an update on what's been happening in our portfolio. Right now, we do have 2 current positions, but I want to follow up on last week's trade, because we designed it to be done by the time we reconvened, and it is done. So let's go see what happened to it. So last week, we placed a trade on NVIDIA. We sold a 17th of July 195 put. The preference there very likely being for that trader. So here we were. This is when we were having our discussion. Price was up here. Typically, the preference is for that trade to just reach expiration, still out of the money, price still above our strike price, and see that thing expire worthless. That's kind of for many seen as the optimal outcome. That's exactly what happened here. Sold the 195 put. It looked like we closed business on Friday at 202.81. That trade never really teased with going in the money. I think we did fairly well on that. But the thing about these short-term options positions that we discussed is that if they do go the wrong direction, there's not much time to get that thing turned around. So in this case, worked out, so that's great. It expired for a $93 profit, or 93 cents per share. Break even on this trade was 93 cents below 195, so 194.07. So Well, Mark says, is Goldilocks stock an antidote to three bearish indicators? Possibly. We're going to be talking about, I didn't think of the, I should have done something funny with three bears, but I didn't. Anyway, let's go have a look at our two current remaining positions. So right now we just have 100 share lots in each of Cardinal Health and Alphabet. So this webcast series is not called Investing in Stocks. It's covered calls and short puts. So these were previously covered calls. And actually, on each of these, we've done a couple of covered calls so far. So let's go check the history of these two stocks and then see if there's anything we want to do, maybe to make them back into a covered call. So here's our Cardinal Health. Bought some shares way back here, nearly 12 months ago now. Didn't really do anything with those. They were just parked in our paper money portfolio and they did their thing. And we finally brought them into this discussion, started selling covered calls back in April. We did a very short-term trade. That was another experiment with a short-term trade. This one worked out again. That trade expired for a 116 profit, 116 bucks added to the overall positive performance of the stock itself. And then we sold a July contract. That one just expired over the weekend for a 465 profit. Now this one was actually in the money. Most of the time the stock was above 230, and you can see just before the close of the week, about midweek, we dipped down below 30 or 230, got back up above on Friday, but closed at 228.52. Now we have a bit of a luxury here in a paper money account. There's no threat at any time of an early assignment situation. It doesn't happen in a fake account. It can certainly happen in a live account. So in a real trade, it's possible these shares may have gotten called. Now, what might that have meant? Well, it would mean that our shares that we purchased for $155 and change, we then sold for $230 after collecting a couple of premiums along the way. It still would be a highly profitable outcome. But I didn't want to let that slide by without making that note that just because we had the luxury of waiting all the way to last moment doesn't mean that's always the case. But that did leave us with our 100 share position. There's an earnings announcement just out on the horizon. Let's say we're among those traders who don't really like to sell a covered call through an earnings announcement where it puts a cap on price appreciation potential if there's a really positive earnings announcement. But let's go ahead and do a new call, but maybe one that expires before August 11th. Let's go see if there's something out there available. So we have, yeah, it looks like August 7th is probably the furthest out that we can push things while still not being under threat of taking this thing through earnings with a covered call in place. So let's come down here to, well, let me do a quick review of the chart. It looks like recent resistance is up there at 240. I don't know if we're going to be able to sell something quite that high. This is just a practice that some traders and investors have if they're trying to minimize the likelihood of assignment. Maybe in that effort, they might look to sell a call at or above a resistance. Let's see. Let's go see if we can get something up there at 240. What does that premium look like? Now, just because I drew a line on a chart and because that was a previous high doesn't mean it can't go above that. We recognize that. Looks like that 240 strike does have some premium there. There is a pretty wide spread here between the bid price and the ask price. $1.40 bid by a 205 ask means there's about a 65-cent difference between those two. The trader might want to make a note of that might indicate not a strong amount of liquidity in those contracts, and really that's not uncommon. First of all, for weekly contracts, and also as we get further out of the money, that can be the case fairly frequently. But how about for this example? I'm going to go ahead and sell a call there. Let's see if we can. Let's try to get at least split the difference. Let's see if we can get $1.70. That's $170 out of that call. Agreeing here, if somebody wants to buy our shares at 240, they can do it. That's what their contract is going to allow them to do. But in exchange for that right, they're going to be paying us, hopefully, $1.70 or more. Let's see if we can do that. Let's click on the bid price. Going to sell that one contract, the 240 call, and let's try to get $1.70 for this. I'm going to set that as our limit price. Anytime we submit a limit order, there's a risk that order might not fill. We might say, hey, I want at least $1.70. The markets might decide not willing to give us $1.70, but let's click confirm and send. Selling the one CAH 7th of August 240 call for $1.70 limit. There is a commission to be paid on this trade. You'll notice the order confirmation dialog box here, the confirmation screen, is telling us there's an infinite loss potential to this trade. That would be true if this were a naked call, but we already own the shares, so this is not a naked call. Placing the sell order in the same account where the shares are held automatically creates that covered call scenario. So let's send this order off, and I'm going to let that one work. We'll see if it fills. If it doesn't fill, we don't have the covered call. We'll just retain ownership of shares, and we'll revisit that next week or maybe after earnings. But now we have Google. Alphabet. What's been going on with this Google position? Again, we just own 100 shares. It was previously a covered call on a couple of occasions. So in this case, we bought the shares 349.11 right here. Then we sold some June calls. Those expired for a $13.40 profit, $1,340, setting commissions aside. We then, after that expiration, sold just more recently, the 17th of July, 375 call. And right there, you can see we got right up to, look at Thursday, we got up to 375.27. So we set this according to a previous high. Do you think anybody else might have been paying attention to those highs? I can never crawl into the minds of every investor or trader out there, but it seems like somebody was paying attention maybe to that previous resistance. Sold off from there. Not great for our share ownership. We don't always want stock price collapsing, but we didn't get called out. That contract just expired worthless for another $315 profit. And we have those shares still above our entry point. So what are we going to do from here? Well, this one has an earnings announcement right over the horizon. I'm not going to sell a covered call on this. Some investors, some traders are totally fine selling right before an earnings. Others, again, maybe prefer not to sell, not to get themselves into a contract where they have to sell the shares at a fixed price when that price might go shooting up on a very strong earnings announcement. So I'm going to leave that one alone. And that brings us up to speed with our previous and current positions. So let's add a new position to our portfolio. But as we do, let's get some market context. Let's go have a look at what's going on with the S&P 500. Been a decent day so far. We're still not terribly high from those all-time highs. Here's a little trick. Just to, again, to give ourselves some context, markets have been kind of choppy. We're not at all-time highs, so it might feel sort of bearish even. Mark, you like that decision to not sell over earnings? Yep, it might be the right way to go. It might not be. You know, a trade-off here is if we sell the call, we have a cap to the upside, but it also can help us absorb some of the downside if we get a downside gap. It's not perfect protection, but a little income can go some distance in helping to offset the loss in capital value of our asset there. Anyway, let's see how far down we are from those highs. This is just an approximation, but if you use the little trend line tool on Thinkorswim, as you are moving and repositioning there, keep your eye up here on the percent change. How high, how much higher were we than we are right now? About 1.8, 1.9%. Or in other words, we're less than 2% below all-time highs on the S&P 500. So that might be helpful in sort of corralling emotions when we're getting a little bit concerned about recent choppiness, recent volatility. But this sort of a condition, here's another thing that we might note. Let me just reposition this for just a moment. I'm actually just going to remove this drawing. But since those highs, and actually stretching even further back, we've kind of been bumping against a price ceiling on the S&P 500. We've really been struggling to advance beyond that. When we own just shares, that's not very productive. Just going sideways, it's not losing money, it's not making money, it's just wasting time. But when we are selling calls along the way, that income might still be adding to the bottom line of the investor, assuming that we're getting to expiration, not having our shares collapse in value individually. So for some income investors, this sort of a period might be just the time when they're choosing to sell covered calls. And that's kind of going to bring me, let's shift gears to my Goldilocks discussion about what might an income investor look for in a stock that may qualify it as just right for selling covered calls? What might be a Goldilocks candidate? So as we go into this discussion, I do not want to leave you with the impression that there's anything such thing as a perfect candidate. There are candidates that might look better than others up front, but then it's up to the markets to decide after that. It's up to reality whether a trade or a market approach actually works out by its conclusion. Marcus, you're late, but glad to be here. Well, welcome aboard. All right, but let's go have a look at a stock that I'm thinking we're probably going to add to our example portfolio. And this is going to be not NVIDIA. We already did that one. It was going to be Broadcom. Third time's the charm. Typing skills kind of failed me on that second one. So here's Broadcom. And I want you to bear in mind what we just saw on the markets. The markets have been kind of sliding sideways for the last couple of months. And for some traders who are looking for income from their stock, from the stocks in their portfolio, or maybe from a new stock they're considering adding to the portfolio, that might be just what they're looking for. First of all, first Goldilocks characteristic might be that our stock is not too bullish. Bottom line, a covered call is a bullish strategy. But this may be typical for Broadcom might be typical for a trader who's looking for a stock that's bullish, but not too bullish. There are certainly times when a stock can just go rocketing up. It can just go shooting up compared to how much it moves over, a similar time frame more typically in the past. And during those times, if a trader is really, really bullish on a stock, let's say that our trader here thought the stock was just going to go shooting up through this resistance and just going to go higher and higher as we're looking out to August, why might some choose not to do a covered call under those circumstances? Well, in that case, maybe they just want to buy the stock and see if what they expect actually pans out. If the stock really goes up high, selling a call can actually put a cap on how much of that ascent we can participate in. Because when we sell a call option, we're taking on an obligation to have to sell our shares at a fixed price, no matter how high that stock goes. Andrew's asking about a scan. I have shared a scan in the past, Andrew. Let me see if bear with me. It would take us a little bit off track right now, but if I recall, check the video description. Maybe I'll put it in the video description after the webcast is over. Or if time permits during the webcast, I might be able to go share a scan with you, but it is a little bit off track with what I wanted to discuss today. So I'll kind of park that one for now. But what's going on with Broadcom that might make a potential income investor think, well, I'm bullish, but not terribly bullish? Well, one thing they might notice, the stock after this big drop, looks like a pretty negative reaction to a recent earnings announcement, dropped hard, and then it's kind of settled in going sideways, up and down and up and down. Buying that stock when it's just going sideways, if it just continues going sideways, may not be productive for the shareholder. But one thing that the would-be covered call trader who's looking for something that's bullish, but not too bullish, might be a stock that's going sideways, potentially even up, but that's just bouncing off a support level, a price floor. Now, just because there's been a price floor in the past doesn't mean it can't go through that. But let's say that our income investor here sees that our stock looks like it might go higher. Great. Let's buy some shares and see if we can get those shares to go higher or witness them. We don't get them. We don't have any influence on whether they go higher or not. But we'll see if the shares can go higher. Let's draw in a line to sort of envision that. But if our shares go up, but we see a potential price ceiling, maybe that's also an opportunity to sell a covered call. In this case, if the trader thinks that the shares may not continue above that level, well, they may want to give the stock room to realize where they think there's potential for appreciation in price, but then recruit income to possibly add to performance. That's the hope here. So I think as we structure this trade, this example trade, we're going to keep that 410 level in mind. We're going to see what kind of premium might be available at that level. But before we have that discussion, I want to talk about other elements, because we've talked about a stock being bullish, but not too bullish. Okay, well, if it's not too bullish, is bearish okay? Look at this. Was it Mark making the joke about the 3 bears? I can't remember. I can pull one bear into this discussion. Yeah, a trader looking for a Goldilocks stock candidate may be looking for a stock that is not too bullish, but also not too bearish. Let's suppose that they see a stock, maybe it's offering big premiums, but it's collapsing in value. And maybe recently it's breaking through a price floor. See if you can envision this. What if we see this stock that's falling hard, it's falling through previous price floors, and maybe it's headed on down to the next one. Who knows? It's certainly been down here in this 300 level previously. Could it go there again? Yeah, it could go there again. So if we buy it at 380 and it collapses while we're waiting, let's say, for an August 21st covered call to come to maturation, expiration, we might just be losing way more on the stock than we're making on the premium. So not too bullish, because a covered call can cap the upside, but also not too bearish, because the stock losses can overwhelm the income collected from the calls, and we still wind up not making money on the strategy. So we're looking for that Goldilocks zone, if you can envision that. Going up, but maybe not up too fast. Sam says, okay, yeah, that's just a sidebar discussion, not a question for me. All right. Now, I'm going to change gears on the discussion here, because I'm going to introduce an indicator not everybody's familiar with. Looking at a price chart, I think it's pretty straightforward just to look at price levels and imagine areas of support and resistance, or price floors and price ceilings. But a trader who's looking for the Goldilocks stock candidate for a covered call may sometimes also look at volatility of the stock, not just, where they think price is headed, but how volatile is price expected to be during the intended time frame of the covered call. So today's July 20th. I'm going to be putting on a covered call out 1 month. That'll take us out to August 21st expiration. Shall I clean up my chart just a little bit as we move to this portion of the discussion? Yeah, let me remove this drawing. Let me remove this drawing. Those two are okay, because that's actually the theoretical outlook of our trader here. But I'm going to come up here and add a technical study known as implied volatility. And that is because for some traders, for their Goldilocks stock candidate, they may be looking for a stock that's not too volatile, but also not too stable. Both of those can have potentially negative implications for the outcome of a covered call position. So let me, there we go. JDLMI asked this question just as I went to this. Cam, do you consider what the IV is? The abbreviation there, IV, implied volatility. Yep, let's add that to our chart. Let's click apply and click OK. And so if you're not terribly familiar, or if you're not familiar at all with this little oscillating green line indicator, what this is doing is, well, for some, it's just viewed as a general gauge of the pricing of options. That's one way to see it. So as this line goes up pretty directly, not across every strike perfectly does it positively influence price, but generally as the green line goes up, the price of the options on Broadcom is going up. As this green line goes down, it's the price of the options on Broadcom are going down. So why are prices going up and down? Well, it has to do with demand for the options and also the volatility expected on the stock. So the name of the indicator is kind of the giveaway, implied volatility. It's a forward-looking indicator that expresses how much volatility options traders are expecting from the stock. And it's related to demand for the options. So when options traders expect a ton of volatility, we'll tend to see this line go up. It literally means their expectations of volatility are rising. Well, that's related to demand because if options traders are expecting a lot of volatility coming over the horizon, there will tend to be strong demand from speculators in options because, if the stock is really volatile and we buy a call, well, a big move up could result in a big profit for a call owner. On the other hand, if the stock is really volatile and we buy a put and there's a big move down, that could produce big profits for the put buyer. So for those speculators, they can see volatility as potential. So as expectations of volatility rise, pricing of options typically rises. That's important for this discussion. But we need to talk about the other side too. As volatility drops, as expectations for volatility drops, the pricing of options on Broadcom will typically drop as well. So let's look at this through the lens of our covered call trader. You might look and see, well, so when this line is way up here, Cameron, you're telling me the volatility expectations are high, and therefore options premiums have probably gone up. And if I'm trying to sell when prices are high, don't we want to sell when volatility is high? Premiums will be high, but we need to be realistic about why those premiums are high. It's because there's a lot of volatility expected. And what you'll see pretty commonly is as this line is going up, there's an earnings announcement approaching. It's not always the case, but look at this. Here's our volatility. Our implied volatility is rising. There's an earnings announcement right around the corner. Our volatility is rising. There's an earnings announcement right around the corner. In this case, there's an obvious reason or an apparent reason. Let me qualify it. We don't always know with 100% certainty, but I'd say we have a pretty good certainty here. When this volatility is rising before this earnings announcement, the covered call seller, would-be covered call seller, probably ought to be aware of that because we are selling right at a time when the stock may do something dramatic. If we sell a covered call right before an earnings announcement and the stock spikes, well, we don't get a lot of that because we have a contractual obligation to sell our shares at a fixed price. If we sell a covered call right before an earnings announcement and the stock plummets, oh, by the way, our CIH call just filled. So there we go. In for $1.71. We wanted at least $1.70. So that filled. Anyway, but if we sell a covered call and all that volatility causes price to plummet, well, we own the shares. We're now watching our shares bleeding. So that high volatility can represent a lot of potential risk to the covered call trader. Now, for some, it might be a justified risk because, as I mentioned, prices of options are very likely going higher. So we're literally probably collecting a premium, collecting very high premiums right before an earnings announcement or right before some other highly volatile event. It might justify in the minds of some that they're okay with selling a covered call. So Mark says, is this the second part of the Goldilocks strategy? Yep, Mark. So the first part is not too bullish, not too bearish. Second part is not too volatile, but also not too stable. I think we can relate very easily to why a trader who sees volatility levels very high, that might be ding, 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 red flag, that there may be some big thing about to happen, and then we're about to sell a covered call and put a cap on how much we can make from that thing, right? So volatility being very high, we might just say too high to some, that might be not in the Goldilocks zone. But also when volatility is very low, maybe for some traders, they don't want to sell there either. Why not? If the expectation of volatility is low, what we're literally, let me put that in other words, just phrase it differently, I should say. During those moments, the options market is kind of expecting calm waters ahead. That's one way to put it. So if we have low volatility, oh, well, this is kind of a stable, expected stock environment. Sounds kind of nice. The problem with that is premiums are probably pretty low. Probably not collecting much premium relative to premiums that might have been had at other times because of that strong correlation between volatility and the pricing of options. We literally are selling at low levels here. That can have a double negative effect. Number one, we get lower premiums. And number two, if that volatility then starts to rise, as it typically does, not always, but typically can continue to fall. But if that volatility were then start to rise, that starts to inflate those prices again. And our cover call trader who may have reasons to want to try to buy out might have to buy out at now higher prices than the relatively smaller price they originally received. So, yeah, in the sort of Goldilocks pun that I'm running with here, uh, maybe not. Maybe a trader doesn't want to sell when volatility is quote unquote too high. That's always in the eye of the observer, or when the volatility level is too low. Instead, what they might do is kind of look at where we've been over the last 12 months as a general gauge, and we might be right sort of in the middle right now. Look at that. We're not way up at peaks where stock is expected to be jumping all over. Look what it did right there as we were really high here. It's also not really low when premiums are low and where it might be tougher to get an exit if those premiums start to go up again. Now we're sort of in that Goldilocks zone. What would be the actual, what would be a potential final preference here? Well, sort of maybe in the Goldilocks zone, but still coming down. If we see volatility drop from current levels, what does that do to the price of the options after we've sold into the contract? Brings the price of those options down. It might allow for a less expensive exit if we ever need to. Let me see, just checking for questions again. I don't see any questions, more observations and sort of sidebar chats, which is great. So guys, there are the sort of four factors: not too bullish, not too bearish, not too volatile, not too stable. And for Broadcom, I think what we're going to do is add this to our example paper money portfolio. But going back to the chart here, let's buy the stock. It looks like it's around 380. If we can buy that at 80, at 380, let's see if we can sell a 410 call. So that means if someone chooses to buy the shares from us, they're going to have to buy those shares for $30 more than we paid for them, assuming we buy around 380. Let's go to the trade tab, see what's available. Now, this is a $380 stock, so it's a $38,000 investment to do a covered call on this, or around there. And I'm going to go out. We're going to be seeing some unfamiliar looking expirations here: 2 days, 4 days, 7 days. Yep, we now have those contracts that are expiring on Monday and Wednesday and Friday. But I'm going to go on out to the 21st of August. It's in black. That tells us it's not a weekly contract. It's one of those more traditional third Friday of the month contracts. It's the monthly contract. Those tend to have narrower spreads between the bid price and the ask price. There tends to be greater liquidity in those. So I'm going to have a look at those. And let's look at the 410. I don't know. Let me see what the premium might be. 410, right now trading 11.95 to 12.55. So we might be able to get a little over 12 bucks per share. That would be right around 3.5% for a 32-day contract. John's asking, hey, Cam, why not use a cash secured put to buy the stock? Well, that's one approach. We'll talk about that in a future discussion. I've talked about it in the past, John. But yeah, some might do that, especially if they're trying to set in motion the wheel of what's called the wheel strategy. Sell a cash secured put or sell a put. If it gets assigned, we now own the shares, then we start selling calls. If it doesn't get assigned, we just sell another put on another stock or maybe the same stock later. Yeah, a lot for me to give you a really good answer to that, John, because it's a really good question. It just takes too much weighing pros and cons. All right. But yeah, we could sell a put. That might wind up in stock ownership, or it might not. But let me, I'm going to sell the 410 call. And with that trading has spread 1175 to 1245. Let's just see if we can get 12 bucks for it. So I'm just going to right click here. Let's put in an order to buy what's known as a covered stock on Thinkorswim. Covered stock means covered call. There we go. That'll put it in order to buy. In my account, I've set my default to be 100 shares and one contract. In paper money accounts that haven't been adjusted, it might be 1,000 shares and 10 contracts. So we just want to make sure that we're getting the number of shares and contracts that we intended. Let's just do 101. So we're going to sell the 21st of August 410 call. Looks like our net debit here. So this is calculating how much would it cost to buy the stock, about 380 bucks. If we then get about $12 of income from the option, the sale of the option, that brings down our net debit to about 368. So I'm rounding off the pennies there to make the point. But let's just leave that right there at the mid price. Let's see. Let me click on the lock there. We'll just lock that in. Say, as a matter of fact, why not just be nice and round? Let's say we're willing to spend a net $368.50 to buy the stock and sell the call. Let's click confirm and send. Buying one covered Broadcom 21st of August 410 covered call for a limit $368.50. That would give us max profit. If we go up to 410, get called out, we get to keep our premium, but we have to sell the shares for 410. If the shares collapse and Broadcom goes to zero in the next 32 days, we might lose our investment in the stock minus the credit from the premium that we have yet to receive. We'll see what we get. And there is a commission to be paid on that call. So we need to be aware of that. But let's send that order off and see if we can get fill. Yep, looks like we got in right away. We offered up to 368.50 total and got us in for 368.42. Let's go see what the precise numbers were there. So we bought the stock for $380.37, and then we sold that call for $11.95. All right, that gave us our net debit of $368.42. So if we were to get called out at 410, it would be just shy of a $30 realized gain at that point, and we would keep our $11.95 from our call. So we're in that new position. We have had this discussion of what sometimes is referred to as the Goldilocks stock for covered calls. Obviously, just because it sounds like a fairy tale doesn't mean it's going to have a happy ending. Did I do pretty good? I just made that up. That's not bad, right? Anyway, yeah, we're going to see how this goes. If the stock collapses in value, we're still the shareholders here. So we certainly still have risk. If the stock rockets up, we might get called out at 410. So we'll talk about the management of this position in future webcasts, but we've accomplished what I wanted to set out to do today. I wanted to talk through the characteristics of what some might consider to be a Goldilocks stock for covered calls, and then go through an example. And we've done that, so we'll have a look at this again next week. We'll follow up on our CAH and Alphabet trades. But in the meantime, I have webcasts every day of the week on a range of topics. As long as the markets are open, if I'm not on vacation, I'm here delivering a discussion on some topic. So I'd love to see you in my other webcasts, which brings me to the point to make sure if you are new to the Trader Talks channel from Schwab here on YouTube, make sure you subscribe to the channel. You can pop down below the video right now. Click on the subscribe button. It only takes a second to do that. It doesn't cost anything to do that. But our Trader Talks channel is where you can go to join these live streams. You can also find playlists of previous webcasts. So for example, if you didn't see the setup and trades for Cardinal Health and for Alphabet or for NVIDIA last week, you can go to playlists here and just scroll down a bit. We have lots of different webcast series, current and previous webcast series. If you scroll down, sort of toward the bottom. It's about 3 rows up from the bottom. There's covered calls and short puts. You click on View Full Playlist, and you'll see there's last week's discussion, the hidden trade-offs of selling weekly puts for income. Talked about the pros and the cons of that strategy last week. Now, Ben and I would also like to issue an invitation to everybody listening, whether you're here live or you're watching on the archive afterward, to follow your favorite Schwab presenters on social media. I get the question, Cameron, how do I contact you, or how do I how do I communicate with you in between these live streams? Social media is the answer. So you can find and follow your Schwab presenters on X and on LinkedIn. You can find Ben on X at Ben Watson CS. You can find me on X at Cameron May CS. Here's what my profile looks like there. That's what you're looking for. Make sure that you're precise with these handles because there can be some similar ones out there. Mine is at Cameron May CS. And if you reply to one of my posts here, I just try to reply right back to you. And there's that communication channel that gets opened up. But you can also follow us on LinkedIn. Just go over to linkedin.com/in, and then /Cameron May CS is my handle there. Give me a follow there. And if you reply to my post there, I reply to right back to you as well. All right. But guys, thank you for giving me your time today. I thought this was kind of a fun topic for a discussion, so we've covered it. We're going to do another discussion on covered calls and short puts in another week. Thanks to everybody who's already clicked the thumbs up. If you attend one of our webcasts or you watch the recording and you enjoy it, make sure that you click the like button. It's helpful every time, live or on the recording. They both count the same, but it's like applause to the presenter for a job well done, yes, but it also gives us a nice boost in the YouTube algorithm so that my videos just get seen by more people. Helps more people find these things. All right, everybody, go have a great day. Lots of webcasts yet to come, so go enjoy those. I will look for you maybe in tomorrow's webcast or in something else through the rest of the week, or we'll just see you again next Monday. Or I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.